We're talking with Andy. Andy, you're with Allworth Money Matters.
Hi, Scott and Pat.
Hi, Andy.
I've been listening to you guys forever, and I'm real happy to have a chance to get some advice.
Oh, cool.
Well, thank you.
I'm glad you called.
Yeah. So my questions are around tax efficiency. I have all these investments. I have a little bit of Roth, not much. Traditional and deferred and brokerage accounts. And then there's all these different asset types, and I don't know which ones belong in which accounts. And whenever you do research, you see things like, oh, this particular investment works best in a Roth. Well, doesn't every investment kind of work better in a Roth? So
Excellent
you
point.
have what you have, and you got to work within the confines of where your money is. And I'm trying to figure out, okay, what goes where?
Okay, so we'll start with the basic outline that this is driven by your asset allocation. So, and the reason it's driven by your asset allocation, so if you said to me, okay, McLean, what do you want your equity exposure to be? And I said, 100% stocks, 100% stocks. And you're like, why? I'm like, well, because the market goes up more than it goes down, and over time it'll be okay, and I can live through the volatility. Then it wouldn't matter whether it went into an IRA or a brokerage or a Roth IRA.
Yeah, I get it. And it's only recently that, there used to be no alternative, right? And so everything I had was equities.
That's
and it
right.
didn't matter.
That's
but
right.
now that I'm branching out and looking at other things, it kind of matters.
So, Scott, take it from here.
Yeah. So the focus is not necessarily on what your tax return is for 2025. The focus needs to be on what's going to yield the highest net worth down the road.
Lifetime return.
Lifetime return. And as we were talking off break, Pat had mentioned that he had got an email from a client recently that said, my CPA said we need more munis in my portfolio. And Pat and I had a kick out of it. Like, the CPA's never even looked at the guy's portfolio. He has no idea what's in the portfolio.
I've got nothing but equities in his brokerage account, and I've got all his bonds in his IRAs. So putting munis in the portfolio would ruin the whole strategy.
That's right. So
yeah, actually, I am really interested in the munis. I'm in a high tax state and a high tax bracket. And
that's right.
It looks fairly compelling.
Understand, but if you think about it, let's give us a breakdown of what's in what. How much money do you have in Roth? How much do you have in brokerage? How much do you have in qualified?
Okay, so it's in deferred and traditional, it's 3.9 million. In brokerage, it's about 700,000, and in Roth, it's about 270,000.
All right, and what's your stock to bond ratio?
It's 75% stock, 15% bond, and 10% in cash.
Okay,
and where's the cash?
It's in cash.
No, I mean, is it in the brokerage account or is it in the IRA?
Okay, yeah, the cash it's in the traditional. Yeah, it's spread fairly evenly in all the accounts.
And how old are you?
52.
And when do you expect you're going to start taking distributions?
That is the question. I like working. I don't have any desire to stop working. Probably 10 years still.
Yeah, you got a lot in your deferred accounts for 52. Is that all your contributions or your spouse as well?
That's us together.
Okay.
Yeah.
So if you think about it, people get excited about munis, and there's nothing wrong with munis. But if I'm taking a discount on what the muni pays because the federal government is subsidizing the taxation, why would I hold them at all? Why wouldn't I just have bonds inside of an IRA or a Roth IRA and get that higher return? And that's how you should think about munis, right? Which is
if you flip these numbers, if you had 3.9 million in a brokerage account and $700,000 in your IRAs, we would say munis might be a great thing for you. But almost everything you have is in tax deferred accounts.
And what's your approximate family income?
Yeah, it's our AGI this year is probably around 830.
Is that pretty consistent?
No, it's not.
This is a high year for you? Or a low year?
It's a high year.
Okay.
And that's post deferral. So I'm like deferring as much as I can.
That's right. So when you look at this, you should have no munis in the portfolio today.
But based on your income in another decade, my guess is you're going to start accumulating more and more in your brokerage.
Mm-hmm.
Yeah. And then at that point in time, you could look at mixing munis in. But remember, these municipal bonds are subsidized by the federal government, which is actually, look, for years and years, the federal government subsidized high tax rate states by allowing the state and local tax deduction.
Yeah.
Right? And you think about it, I hated it when Trump passed that thing because it hurt me directly. But I realized that
I remember talking to my congressman. I said, well, personally, I don't like it at all, but philosophically, I think it makes a lot of sense to get rid of that.
That's right. That's right. So you should have all your highly appreciated assets in your brokerage account and mix the rest of the portfolio everywhere else.
Okay.
You want to have that as highly efficient tax as possible. And again, because the vast majority of your wealth is in tax-deferred accounts, means you're going to have some fixed income. Until the point you have no fixed income in your brokerage accounts, you're not going to benefit from munis.
Yeah, keep the fixed
I'm not
income.
brokerage. I misspoke. The day you have no fixed income in your tax-deferred accounts is the day it's going to make some sense to have some municipal bonds.